Wow. Gold is on an absolute tear, smashing through records and leaving everybody wondering, are we about to witness the launch of a new parabolic run, or are we staring over the edge of a cliff? We have to dive into this because, the signals, they're pointing in two completely different directions at the same time.
And there it is. Take a look at that number. Gold just blasted through to a brand new all-time high, closing out the session at an incredible $5,105.02. I mean, the market is just buzzing right now, and for good reason, right? Moves like this, they can make fortunes, but they can also end them just as quickly.
So, this really brings us to the core question, the big dilemma we're tackling in this explainer. Is this breakout a real epic buying opportunity, or is it just a classic bull trap designed to suck everyone in right at the very top? All right, let's break down the evidence and see what we can find. Okay, first up, let's make the case for the bulls. Let's look at the argument for why this thing could just keep on climbing. When you zoom in, to the shorter time frames, the picture looks incredibly strong. We're talking about the daily charts, the 4-hour charts, the stuff that active traders are glued to every single day.
And the read from the big institutions on this, it's pretty clear. This daily move, it isn't just random noise. No, this is what they see as a legitimate, confirmed breakout from that recent choppy zone, and it happened with some real force behind it. So what does that suggest? Well, that the path of least resistance, at least right now, is probably higher.
Okay, now this is where it gets really interesting. Let's look at what the indicators are telling us under the hood. First, check out the daily RSI. That's our momentum gauge, right? It's sitting at 57. That is nowhere near overbought territory, which is usually up at 70. So it has plenty of fuel left in the tank. Then you look at the MACD. It's just starting to cross over into positive territory, signaling fresh bullish momentum. And maybe most importantly, look at the on-balance volume, the OBV. It's rising. That's a huge sign that the big money, the institutional players, are buying in.
So if you put it all together for the short-term case, what do we have? Gold just punched through a major psychological range. Momentum is building. We saw that beautiful V-shaped bounce from the lows, and the price is sitting above all the key moving averages. I mean, that's a textbook bullish setup right there.
But, and this is a huge but, if you stop there, you're missing a massive, massive piece of the puzzle. We need to pull way back. Forget the day-to-day noise for a second, and look at the big picture. Let's get that view from orbit. And what we see from up there is, honestly, it's kind of terrifying.
Look, the power of that daily chart is totally real. I'm not discounting it, but it can also be a mirage. To really get a grip on the kind of risk we're dealing with here, we have to zoom all the way out to the monthly chart. And that tells a completely different story, one that spans years, not just days.
Just look at that number, 95.17. Do you know what that is? That is the RSI on the monthly chart. Let me put that into perspective for you. We consider anything over 70 to be overbought. Hitting 95, that's what they call a 5 sigma event. It's basically a historical anomaly. It's screaming that this asset is stretched to a totally unsustainable, parabolic breaking point. This is, without a doubt, the single biggest red flag in the entire market right now.
So what exactly is a monthly RSI of 95 warning us about? Well, it's warning of a potential blow-off top. And what's that? It's a pattern of just pure speculative frenzy. It's when the price goes almost vertical, right before it collapses under its own weight. This is the final, exhausted, last gasp of a bull market, and believe me, it almost never ends well for the people who buy in at the very peak.
And this right here, this perfectly sums up the dilemma, right? On one side, you've got the short-term picture, powerful, clean breakout, strong momentum. On the other side, you've got this massive long-term risk, a historic overextension that is just screaming danger. So the question is, when the market is sending you two completely opposite signals, what on earth are you supposed to do?
Well, this is where the pros really earn their money. See, when they're faced with a contradiction this huge, they know that trying to predict what happens next is just a fool's errand. It's a losing game. So what do they do instead? They build a rock-solid plan. A plan that prepares them for either outcome. Let's take a look at how they're actually approaching this.
And this is the key. Seriously, if you take one thing away, let it be this. Amateurs bet on being right. Professionals plan for what to do when they're wrong. They define their rules of engagement before the market ever makes a move. That way, they take emotion completely out of the equation and just stick to their discipline, no matter how crazy things get. So the whole institutional plan really boils down to two main scenarios. First, you have scenario A, which is a bullish continuation. Basically, this breakout keeps on running. And then you have scenario B, which is a mean reversion, where that crazy monthly reading causes the price to snap back down towards a more reasonable level.
All right, let's dig into scenario A first. The pros are actually giving this a slight edge, about a 55% probability. So what's the trigger? They're watching for a solid 4-hour close above 5110. If that happens, it confirms the breakout. And their targets? They're looking at 5150 first, and then up to that big psychological level of 5200. And crucially, they have their stop loss locked in at 5045. Risk is defined right from the start.
Okay, now for the other side of the coin. Scenario B, the correction, is sitting at a 45% probability. The trigger here is a close below 5090 on the 1-hour chart. That would be the first real sign of weakness. If we see that, they'll be looking for a drop towards 5020, and maybe even all the way down to that key support around 4950. And their stop loss, it's placed just above those recent highs, protecting them in case it's just a fake out to the downside.
So after all that, what does this actually boil down to? It all comes down to a handful of really critical price levels. These are the lines in the sand that are going to tell us which of these two scenarios is actually playing out. Think of this slide as your cheat sheet for the week. The most important number on here, the ultimate line in the sand, is 5090. That's the pivot. If we're above it, the bulls in scenario A are in charge. If we drop below it, the bears from scenario B take the wheel. You've got to watch that level like a hawk. It's the market's center of gravity right now.
And so here it is, the final verdict from the institutional desk. Their primary bias? Cautiously bullish. Why? Because you just can't fight this short-term momentum. But that comes with a huge asterisk, a massive warning about elevated crash risk. And they keep coming back to it. That monthly RSI at 95 is a 5 sigma event. It's a historical red flag that you absolutely positively cannot ignore.
So there you have it. The daily chart is screaming go, but the monthly chart is screaming stop. I mean, this is the very definition of an uncertain, conflicted market. So the real question, the one that truly matters, isn't what's gold going to do next? No, the question is what are you going to do when it finally makes its move? The pros have their plan ready. Do you?